If you're looking for a seller finance contract for your real estate deals, by the end of this video, I'm gonna give you my newly revised contract for this year. I mean, my attorney really worked her magic on it, and I'm gonna walk you through the key strategies that she added so you can make more money on your seller finance deals. I mean, if you're not making the money that you want in real estate, or just you're not finding the money that you need to invest, you're gonna love all 10 of these tricks, including the get out of jail free strategies should all shit hit the fan for you. And the last one, it's gonna help you sell every seller finance deal moving forward for above market value. These are the same strategies that this epic investor used to build an $8 million portfolio in less than 5 years without needing banks. For example, check out what this clause allows you to do. It's like upgrading your phone but keeping the same unlimited minutes plan. Let's say you find a better property for your portfolio and you don't want to sell your latest deal because the seller's loan terms are so good. With the substitution of collateral clause, you can move your loan to another property to free it up to sell so you can buy the new one. This maneuver can be a game changer for you when your portfolio grows and you want to increase your ROI. Before I get too deep into the other 9 strategies, let me do a quick rundown of what seller financing is and how it works. Imagine you want to buy a house, but instead of going to a bank for a loan and dealing with their paperwork and qualification process, you strike a deal directly with the seller to where they'll accept monthly payments from you. You still own the property from day one, just as if a bank were involved, but you're making your mortgage payments to the seller instead. Everything else about the sale, it's exactly the same as it would have been had you gone to the bank for a loan. People come to me because they want to learn creative ways of using seller financing. And one of the bigger mysteries about seller financing is, what paperwork do you need? So I'll walk you through it. And if you want to get better at investing in real estate, you need to make sure you're subscribed to Epic for housing market updates, creative financing methods, and the occasional crazy but useful real estate story. Now, the first piece of paperwork you'll need is a real estate purchase agreement. And just about anyone will do. And here's what I mean. You know, every single contract should have a section for additional terms. This one says terms of purchase. And it's here where you'd write in those seller finance terms, like the interest rate, the payment schedule, and the amount of time that you have to pay the loan. And the good news is, you don't need a lawyer to do this, or any official language. As long as you, the seller, and your closing agent understand what's being agreed to, 5th grade English will do, such as price, $300,000. Here's your terms. Buyer pays $50,000 at closing. Seller will wait for the rest, $250,000, and will act like a bank, accepting monthly payments, charging the buyer 6% interest for 30 years until paid in full. That's it. No legal jargon required. And know that you can literally write in whatever you want here. If the seller agrees to selling their house in exchange for a Domino's pizza being delivered to their new home every Friday night for the next 30 years, then you'd write that in. You see, with seller financing, you're not limited to the terms you would be by Wells Fargo or Bank of America. As long as you and the seller agree, anything goes. Now, when you and the seller come to an agreement, this is the second document you'll need, the promissory note, where you'll find the terms of the paperwork. And if you get this part wrong, you're gonna leave a lot of money on the table. And here's what I mean. Most people know how to make money in terms of the sale. You know, buy at a low price. Fewer people know how to make money in terms of the financing. You get a low down payment and get a low interest rate. But almost nobody knows how to make money in terms of the paperwork. And I'll give you 9 more of these money-making clauses in this paperwork and why they are important to your bottom line. The second clause that I want to show you, right of first refusal to purchase note. This gives you first crack if the seller decides to sell your loan, often leading to a discount. For example, if another investor offers to buy your note, the seller must offer it to you first, allowing you to possibly buy it cheaper or negotiate better terms for yourself. You see, if the term of your note exceeds 7 years, you can almost guarantee that this scenario will show up at least once. I mean, if the seller is going to give a discount to someone else, you at least want the option to get that discount too, right? Of course you do. Clause number 3, subordination. This is kind of like the seller giving someone else permission to cut in front of the line. And it works like this. When you have a loan secured by a property, that loan usually gets first dibs on the property if something goes south, like if you can't pay back the loan. But with a subordination clause, the seller is agreeing that if you get another loan in the future, this seller finance loan can take a back seat, letting the new loan cut in front. Why would you want this? Well, if you want to pull out some cash, a bank might agree to give it to you, but only if they're in first position. Now, because you have the subordination clause in your note, it's no problem. This flexibility can be a huge advantage in growing your portfolio. Next clause, extension of note. I mean, let's say you're a year away from making your final payment to the seller, but life throws you a curveball. A big expense, maybe a new business opportunity, or an unexpected financial hiccup. Instead of panicking about making your loan payments on time, you can use the extension of note clause to negotiate a little breathing room, extending the loan's due date. Now, if all shit hits the fan for you, you're gonna love number 6, but first, let's talk about number 5. Imagine if the cost of your favorite streaming service could go up or down based on the price of movie tickets. That's kind of how the prime rate adjustment clause works for loans. It ties your loan's interest rate to the prime rate, which is the rate banks give to their best customers. When the prime rate changes, so does your loan's interest rate. So if the economy does its thing and the prime rate goes up, so can your rate. But why would you want that? Well, because you can use this flexibility to negotiate a lower rate to start. It can be a bit of a gamble, but one that can pay off significantly. And to hedge your bet, you can dictate what amount of prime rate increase causes a rate change for you and how frequently it can happen. You can place limits on it. Further, if the prime rate drops, so does your rate. Or maybe you negotiate it can only drop and never go up. You can remove limits too. Remember, as long as you and the seller agree, anything goes. Now, should you overplay your hand and the economy doesn't work in your favor at all, that's why you have this, the financial hardship escalation clause. This is the financial world's version of a safety net to catch you in the event you end up in a tight spot and need some temporary relief from your loan obligation. Maybe you lose your job, have a medical emergency, or another big financial surprise that makes it tough to meet your monthly payments. With this clause, you can reach out to the seller and say, hey, I'm gonna bind here. And that clause, it kicks in. It could mean pausing your payments, reducing them, or some other arrangement you two agree to while you get back on your feet. The partial payment acceptance clause, that can be a lifesaver for just some short-term relief. I mean, maybe you hit just a rough month and you're a little short, but it's not a full-blown financial hardship. This clause allows you to make a smaller payment, at least temporarily, without the seller considering you in default. This will keep you in good standing and avoid any penalties that might be in play while you round up the rest of the cash. Now, this next clause is something I do regularly, but informally. But now I have it written directly and formally into my note. The early payoff principal discount clause. This gives you the ability to get a discount if you can pay off your loan sooner than scheduled. I mean, say you come into some extra cash, maybe from another investment paying off, you just did a big flip or a windfall inheritance. It might make sense for you to pay the seller a lump sum of $90,000 instead of continuing to make interest payments on the $100,000 left on your loan. In my experience, this has always been a win-win because you save money and the seller cashes out faster than expected. Now, before I cover the last 2 clauses, of which just might be your 2 favorites, and give you a copy of the note, which one so far do you see having the biggest impact on your real estate investing? Share with me in the comments, I wanna know. If you're investing in the South and or the Midwest, you're gonna love this one. I mean, imagine you've got a property, say in Oklahoma, and a tornado decides to redecorate your property without your permission. The natural disaster relief clause allows for a pause in your loan or a reduction in your payments while you deal with repairs, insurance claims, and rebuilding efforts. Now, here's the one that you've been waiting for. Here's where this last clause really shines. Suppose you found a killer deal on a property, you fixed it up, and now you're sitting pretty with a nice chunk of equity and solid cash flow, but you want to move on to bigger and better deals anyway. So you decide to sell. Under normal circumstances, you'd have to pay off your seller financing. But with the transfer of the property clause, you can leave the loan in place. This means your buyer can just pick up where you left off, making the same payments under the same terms. And they'll pay you a premium for that convenience. So if you're now ready to do more seller finance deals, you can grab a free copy of this promissory note with all of its clauses as promised at epicpromissorynote.com. And now that you know how these clauses work, I'd like to help you find more seller finance deals. And that's why I pulled this video up for you here next. Thanks for watching. I'll see you next time. Take care.